Hi, welcome to Elements in Focus. My name is Grant Soliven.
And I'm Aaron Rheaume.
You've got two handsome advisors with you on, on the chat today. And when we do these Elements in Focus, remember, if you've been watching these periodically as they come out to your email, remember what we do in Elements Focus is we focus on our 5 critical elements. And again, that's a trademark process surrounded by your vision that we use to dive deep into planning techniques and planning styles for the families we serve. Today, we're going to focus on essentially tax planning and a certain element of tax planning, Aaron, which is making sure you're efficient, utilizing qualified charitable donations, which is QCD, the cute little acronym we have here, and also appreciated stock gifts. So, Aaron, if we're sitting with a family and they've got a giant required minimum distribution coming, how can they gift effectively with a qualified charitable donation?
Okay, so first let's define what a required minimum distribution is.
I like it.
And that is basically the IRS telling you at age 72, you've got an IRA with tax-deferred dollars. We're starting to force you to take those distributions. Whether you need the income or not, you have to take the distributions. Where Grant had mentioned the term QCD, that stands for Qualified Charitable Distribution or Donation, is where you can give a portion or up to $100,000 out of your required minimum distribution to a 501c3, a not-for-profit. And so that's using, that strategy if you don't need the income to reduce the tax situation that you could be in through a charitable gift.
And that's huge because we know this, Aaron, the Secure Act essentially changed for us the age from 70 and a half of taking your required minimum distribution to 72. But did they change the requirement on the QCD at all?
No, that still starts at 70 and a half, and you just led me right into a good point. So
Beautiful.
Thanks for driving that truck there.
Anytime.
Good job.
So yeah, and it's a beautiful technique that we often use and often forget. Just remember, if you're doing a QCD, make sure you take the information that you get at the end of the year for tax season. You're going to get a 1099-R. And again, that distribution, you might have to tell your tax preparer that this was a QCD, or they might count it as income, right?
Or better yet, come on in and see us and work with the Financial Enhancement Group, and we will help you through that strategy.
And we'll take care of that communication with your CPA. And that's a great point, Aaron. Now, let's not leave appreciate stock gifts out of the conversation because that's just as powerful. And so I'm gonna lob you the ball and let you take it from here because there's so many ways we go through this.
So, one of the things that I'm passionate about and a lot of people at our firm is making sure that we are helping people with efficient giving, not just the folks at our firm, but the people that we take care of are very, very charitably inclined. They have been passionate about giving. We just want to make sure we're helping folks do that in the most efficient way. And so the other mention that Grant talked about is doing an appreciated stock gift. You can go back to one of our podcast episodes or radio episodes where taxes and investment meet, part 2. Joe and I talk about this on the radio. But using the appreciated asset is where you essentially give a stock to the not-for-profit and donate that stock to where they sell it and don't pay any capital gains. So let's really quick just break down XYZ stock. Let's say you bought that for $10 a share. Today it's worth $100 a share. And you want to give $100 to the church or charity. Instead of writing a $100 check, you can move that $100 into the church's donation account. They pay the tax, and so you reduce your capital gain of $90 inside of that share of XYZ stock.
And 2 things as a disclaimer, XYZ stock does not exist. So when Aaron's talking about those, it's a fictitious stock.
I was trying to be as fictitious.
I know. Well, so someone calls in and says, hey, what was that XYZ stock they're talking about? It's fictitious.
Yeah.
But Aaron, it's beautiful. And the reason we do this importantly and quickly is most of us have been trained to give money from our pockets, from our income to these organizations.
Yes.
And remember, when you do that, you're only giving a portion of a dollar. So depending on your tax rate, you could only be giving potentially 70 or 60% of that dollar or 60 or 70 cents to a charitable organization, whereas you could give them a full appreciated stock and they pay no tax and they're getting more bang for their buck. It's deductible to you and you get to keep some of that cash that's already been taxed. It's beautiful and a win-win for everybody. And so absolutely check out the radio show and podcast that Aaron and Joe just did on this. Fantastic subject, fantastic listen. And so actually, with that being said, Aaron, how can they hear us and how can they get a hold of us?
Yeah, so check our podcast out. It's called the Consider This Program, and you can find that on Apple, Spotify, and then lastly, we're our managing partners on several radio stations. Grant and I help in sometimes, WIBC, Shine 99, and you can find us at yourlifeafterwork.com. Reach out to us, schedule a next steps meeting, and we can talk about your unique situation further in the office.
I love that. And don't forget to check out our market carver, where our managing partner, Joe Clark, and our chief investment officer, Adam, generally go on and talk about what we're feeling is going on in the market a week past. Because, again, these two tie in really well together, investments and planning. Don't forget they're married. But, again, thanks for being with us, and we'll see you next time.